Module Overview. International Accounting Standard 1, IAS 1, titled Presentation of Financial Statements, sets out the overall requirements for the structure, content, and presentation of financial statements. It ensures comparability both over time for the same entity and across different reporting entities. IAS 1 does not prescribe specific measurement or recognition rules, but it lays the foundational framework that guides how financial information is presented in line with IFRS principles. The standard applies to all general-purpose financial statements prepared and presented under IFRS. Purpose and scope of IAS 1. The primary goal of IAS 1 is to ensure that financial statements are understandable, relevant, reliable, and comparable. Provide information about the entity's financial position, statement of financial position, financial performance, statement of profit or loss and other comprehensive income, cash flows, statement of cash flows, changes in equity, scope. IAS 1 applies to complete sets of financial statements, including consolidated or separate financials. Components of a complete set of financial statements. Under IAS 1, a complete set of financial statements includes statement of financial position, balance sheet, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, notes, including significant accounting policies, other explanatory information, comparative information for the preceding period, statement of financial position as at the beginning of the earliest comparative period if restatements or reclassifications occur. Fair presentation and compliance with IFRS. Entities must present financial statements that fairly represent the financial position, performance, and cash flows. Comply with IFRS in full. Disclose any departures from IFRS only in rare cases where compliance would be misleading. Fair presentation requires selection and application of appropriate accounting policies, accurate representation of transactions, adequate disclosures. Going concern assumption. IAS 1 requires that financial statements be prepared on a going concern basis unless management intends to liquidate the entity or cease operations, or there is no realistic alternative but to do so. If the going concern basis is not used, the fact must be disclosed, along with the basis of preparation and the reasons for departure. Accrual basis of accounting. Financial statements must be prepared using the accrual basis except for cash flow statements. This means revenue is recognized when earned, not when received. Expenses are recognized when incurred, not when paid. This basis improves the relevance and comparability of financial information. Materiality and aggregation. Items that are material must be presented separately. Immaterial items can be aggregated with similar items. Materiality depends on size and nature, judged in context. This allows users to focus on significant data and reduce clutter. Offsetting. IAS 1 generally prohibits offsetting assets and liabilities or income and expenses unless specifically allowed by another IFRS, e.g. IFRS 9(4), netting derivatives. Offsetting reduces transparency and is only allowed when it reflects the substance of the transaction. Structure and content of financial statements. Statement of financial position must include assets, current and non-current, liabilities, current and non-current, equity, share capital, reserves, retained earnings. An entity can present items, either based on liquidity or in current/non-current classification statement of profit or loss and OCI, presented in single statement format with profit and OCI combined, or two-statement format, separate profit loss and OCI, includes revenue, finance costs, share of profit/loss of associates, tax expense, profit/loss, other comprehensive income, OCI, items reclassified to profit/loss, items not reclassified, statement of changes in equity, shows total comprehensive income, transactions with owners, opening and closing balances of each component of equity, statement of cash flows, required by IAS 7 but referenced in IAS 1, shows cash flows from operating activities, investing activities, financing activities. Notes to the financial statements. Notes should present accounting policies, explain judgments and assumptions, disclose risk management, contingencies, commitments, etc. Provide entity-specific and transparent disclosures. Case study. Application of IAS 1 scenario. A multinational company operates in both tech and energy sectors. During the year, it incurs major restructuring costs and gains from asset revaluations. Application. Present restructuring costs as a separate line item if material. Disclose valuation gains in OCI. Clearly distinguish profit for the period from total comprehensive income. This ensures that stakeholders can evaluate core operations versus other items. Summary of key points. International accounting standards. 1 provides the presentation framework for IFRS compliant financials. Requires fair presentation, comparability, and disclosure clarity. Mandates accrual accounting and going concern assumption. Prohibits arbitrary offsetting and encourages materiality-based grouping. Emphasizes transparency in structure and notes.